Good evening and welcome to the Money Show. I'm Kavita Thapliyal and this is the show that puts your money matters front and center in a world full of financial noise. We are here to bring you clarity, confidence and control over your personal finances. Whether you are planning for retirement, building a portfolio, navigating debt or just trying to make smarter money decisions, this is your space, your guide and your daily check-in with your wallet. Every evening we bring you insights from top financial experts, decode the latest trends, answer your burning questions on saving, investing, spending, and everything in between. Because you're on the Money Show, we believe one thing: you don't have to be a finance expert to take charge of your money. You just need the right advice. So let's dive right in. And also, this show has a very specific feature of answering your portfolio queries. Just in case you have anything related to your portfolio investments or your strategies that you want help from our experts, just send across your questions on our WhatsApp number and email ID that's flashing on the screen, and we will answer it live on the show. So let's begin. And 2025 was a year of contradictions for Indian markets. So while domestic liquidity remained strong and interest rates moved decisively lower, global trade tensions, FPI outflows, IPO supply pressure, and earnings volatility kept equities under stress. Indian markets underperformed most global peers, valuation premiums narrowed sharply, and investors' confidence was repeatedly tested. Now, as we step into 2026, the market narrative is shifting from noise to clarity. Earnings growth is showing early signs of revival. Consumption appears to be bottoming out. Valuation in several sectors are now below historical averages, and the possibility of FPI flows returning is back on the table. The big question now is India at the start of a new opportunity cycle, or are risks still being underestimated? Now, to decode this transition and understand what 2026 could truly mean for investors, we are joined by Mr. Satish Ramanathan, CIO Equity, GM Financial Mutual Fund. Satish, hi, evening and welcome to the show. And let's begin with the latest global developments. President Trump is once again dominating headlines. It's so difficult for him to stay away from headlines. Now, the fresh geopolitical tensions following US action in Venezuela, while markets are currently factoring in only a limited impact, how are you assessing this development from an investor's perspective? Are there any specific sectors that could see a disproportionate impact from these geopolitical risks now?
I think when it comes to the US action on Venezuela, we don't know as to what the long term implications are as yet. As regards the mineral exports out of Venezuela, which is crude essentially, their output had already come down dramatically because of their issues on exploration. And consequently, the impact on crude prices is negligible at this juncture. But what it does ask the question is that will US now take action against other countries in the LATAM market, LATAM region? Will it stop with Venezuela? And all these kind of questions. And tomorrow it can be any hostile country that it deems fit to take action and take their leaders out or whatever it is. So I think that does bring in a period of uncertainty for the markets. We need to be a little more cautious than where we were, say, on 1st January.
Right. So once again, one needs to be cautious. And yes, geopolitical tension is something that is not under your control. But then what is in your control? Satish, let's talk about markets and valuation. Indian markets were among the weakest performers globally in 2025. Do you believe the underperformance has corrected excess valuations meaningfully? Over 55% of the Nifty 500 universe is now trading at a discount to its historical forward PE. Is this creating selective buying opportunities, or is it a value trap? How are you looking at it?
I think we need to look at it in two distinct aspects. One is the growth aspect. I think Indian economy continues to remain robust and earnings will continue to grow and actually accelerate because the earnings momentum is building up. The second is on the valuation side. On the valuation side, Indian equities are still not very cheap. They are above the median valuations that we have seen over the past 5 years. I think there is still some kind of scope for consolidation of markets, and we shouldn't get carried away into believing that markets have corrected for 1 year and therefore it's become cheap. It's not cheap, it's not expensive, but it can correct a little bit more, either due to a time correction or price correction.
All right. Earnings and growth, after six consecutive quarters, earning growth has begun to improve. The Nifty 500 PAT growth near 16%. How confident are you about the sustainability of this recovery now?
I think the period of consolidation of earnings and weak earnings was impacted by a number of events which were out of the control of corporates. If you look at weak monsoons or extended monsoons and weak consumption sentiment, government capex taking a retreat, and there's several other things that were out of the corporate's control. I think most of these things are kind of stabilizing, may not be contributing positively, but at least stabilizing. And that itself is a relief for corporate India to keep moving up in terms of earnings momentum. Also, the interest costs are likely to come down, which is a key positive for corporate India. So I think that, along with benign inflation and a pickup in consumption, sets the stage for earnings momentum and recovery to take place.
All right. Let's talk about the flows and the global factors over here. So FPI outflows dominated 2025, but India's valuation premium has sharply narrowed and the dollar is expected to soften now. When do you realistically see FPI flows returning, Satish?
I think in the period of uncertainty, FPI flows shouldn't be counted upon as the only flow that will support markets. It has to be a combination of FPI, domestic, retail, and institutions. In terms of the FPI flows, I think the narrative is much cheaper in China, Korea, and other countries. So they will continue to be there till we start demonstrating sustainable growth in earnings and also valuations become more reasonable. But at this juncture, I'm not banking upon FPI flows coming in a hurry. Maybe towards the second half of 26, we could start seeing some flows come through.
Now, let's also look at the outlook, that your fund house has shared. The report suggests that India could emerge as an anti-AI trade. Now, what does this exactly mean? Can you explain, from the global allocators aspect, how can we understand this?
I think the anti-AI trade is something which what we wanted to highlight is that a lot of the market cap correction that took place in our IT sector was because it was conventional IT and there could be a disruption due to AI eating the cake in a way. But if you look at it over the medium term, what we have seen is that every new opportunity, be it cloud, be it Y2K, be it ERP, all these kind of opportunities have actually broadened the base and widened the market opportunities for Indian IT. So if AI picks up, then there may be some other job creation for Indian IT, but it may lead to some contraction of conventional volume. If AI does not pick up, then we are where we are, and that's a good thing for Indian IT.
Perfect. Consumption showed a nascent recovery supported by GST cuts, falling inflation, and rural wage growth. Now, is this enough to drive a sustained demand cycle? How are you looking at, and how are you looking at consumption and capex, specifically becoming the main theme now going ahead?
No, I think what needs to be done and is the need of the hour is to stimulate both consumption and capex to keep the domestic economy robust. Because we were earlier banking upon exports as the model to grow our economy and then keep consumption picking up based on exports. But given the global volatility, we should not bank on exports as becoming the key driver of Indian economy. It has to be capex and consumption. So create jobs through capex and then push consumption. And I think these are the two imperatives that the government needs to focus on. But government is walking a tightrope because it has cut GST. It needs to find the finances. It needs to control fiscal deficit as well. So how they manage remains to be the $1 trillion question.
Would you say 2026 is more about aggressive risk taking or disciplined stock selection at reasonable valuations?
It's not about aggressive risk taking, but I think given the correction that we have seen in 2025, I would bet on the latter part of your statement, which is picking up good quality stocks at reasonable valuations.
What are your specific sectors on radar, where investors can really look at and allocate or maybe reshuffle their portfolio or their investments?
I think there are opportunities across sectors. There are one, you have continuous growth sectors in pharma, healthcare, which will continue to deliver double-digit growth for the foreseeable future. And then you have sectors like engineering, manufacturing, which will also deliver double-digit growth given the underpenetration, as also infrastructure and financials. So I think there are opportunities across the board. To get double-digit growth is not too much of a challenge, really.
With that, it's a wrap on this particular segment as well. Thank you so much, Satish, for taking your time out and helping our viewers strategize an investment portfolio. Thank you so much. And time for a short break, but then post that, let's get connected to our financial advisor who will be giving you live recommendation and advice on your financial portfolio after this break.